People who quietly build wealth over decades, not inherited wealth, not lottery winners, tend to share one habit. It is not an aggressive strategy. It is not a hot stock tip or a clever market play. It is something so unglamorous that the entire personal finance content industry has almost no incentive to ever tell you what it is. I'm going to tell you anyway. Before I get to it, and I will, here is exactly what you are going to understand by the end of this video. 1. Why strategies that feel exciting often create more behavioral mistakes than they solve. 2. What the research on long-term investor behavior actually shows about ordinary people and markets. 3. The specific mechanism that removes bad decisions from the investing process, and how to set it up today. I'm Yunus. This is Wealth Tactics. Let's get into it. The financial content world is not short on exciting ideas. Beat the market. Buy this undervalued stock before Wall Street catches on. Flip properties. Build passive income. Trade volatility. Follow this crypto signal. Find the arbitrage before the window closes. I want to be clear about something. Some of those strategies have worked for some people. Real estate can build wealth. Entrepreneurship can build wealth. Individual stock picking has made people rich. The argument here is not that exciting strategies are inherently worthless. The argument is more specific than that, and it's more uncomfortable. Every exciting strategy has one thing in common. It encourages frequent decisions, new information, new opportunities, new reactions. Buy now, sell before the drop, reallocate, pivot, move fast. And frequent decisions are exactly where most investors lose money, not because they are unintelligent, but because the conditions under which they are making those decisions are specifically bad for making good ones. Here is the central idea of this entire video. The problem is often not that investors know too little. It is that they make too many unnecessary decisions at exactly the wrong moments. Knowledge does not protect against this. In fact, sometimes it makes it worse, because someone with more financial knowledge has more frameworks for justifying a bad decision when their emotions are pushing them toward it. More on that in a moment. First, let me show you what the data actually says about how this plays out. For several decades, a research firm called DALBAR has published an annual study called the Quantitative Analysis of Investor Behavior. It tracks the returns that average investors actually earned. Not the market's returns, but what real people received after their buying and selling decisions. The finding, repeated year after year, is consistent. The average investor significantly underperforms the market over long periods, not by a small margin, by a large one. The gap varies by year and measurement period, but the direction is almost always the same. Ordinary investors, making ordinary decisions about when to buy and when to sell, earn substantially less than someone who simply held a broad market fund and did nothing. The market goes up over long periods. Most investors capture only a portion of those gains because they sell when prices fall, buy back when confidence returns, and consistently make those moves at the wrong points in the cycle. This is not a failure of information. It is a failure of behavior, and behavior is where wealth is actually built or destroyed. There is a story that has circulated in investing circles for years. Various versions attribute it to Fidelity, one of the largest investment brokerages in the world. The story goes like this. An internal analysis of account performance found that some of the best performing accounts belonged to investors who had, in various ways, completely stopped interacting with their investments. Some had forgotten they had the account. Some, in certain versions of the story, had passed away. Whether every detail of that story is precisely accurate or not, and I want to be clear that I cannot verify the exact original source. The underlying principle it illustrates is real and documented. Investors who make fewer decisions often achieve better long-term results than investors who make more. Let that sit for a moment. The best performing accounts may belong to people who essentially did nothing. Not because nothing is the sophisticated strategy, but because doing nothing avoids all the costly decisions that doing something creates. Here is where it gets more interesting, because the obvious follow-up question is, if the research is this clear, why doesn't everyone just buy a diversified fund and leave it alone? The answer is not laziness, and it is not stupidity. It is biology. Human brains are wired for loss aversion. Research in behavioral economics, notably the work of Daniel Kahneman and Amos Tversky, consistently shows that losses feel roughly twice as painful as equivalent gains feel good. In practical terms, watching your investment account fall by $5,000 feels significantly worse than watching it gain $5,000 feels good. This asymmetry was useful for survival in a world where resources were scarce and threats were immediate. It is specifically bad for long-term investing, where the correct response to a 30% market decline is usually to stay invested, and possibly to invest more, while your emotional brain is loudly reporting that something has gone catastrophically wrong and immediate action is required, and the content ecosystem does not help. When markets fall, every financial news channel, every app notification, every comment section is full of theories, predictions, and panic. The information environment is designed for engagement, which means it amplifies uncertainty and urgency. The rational, evidence-based response: continue your automatic contributions. Don't check the balance daily. Wait. Generates no content, no clicks, and no revenue. So staying the course is harder than it sounds. Not because investors are irrational, because they are human, and the conditions around a market decline are specifically designed to activate every decision-making instinct they have. This is where the actual solution comes in. And it is not discipline. Discipline is a resource that depletes. People with strong financial convictions still panic during a bad market. People who genuinely believe in long-term investing still check their balances daily when the news is frightening. Willpower is not a reliable financial strategy. The solution is automation, not because it is sophisticated, because it removes the opportunity for a bad decision to happen in the first place. An automatic monthly investment contribution processes whether you are feeling confident or anxious. It buys during down markets as well as up ones, which is mathematically useful because down market purchases buy more shares for the same money. It does not consult your emotional state before running. This is the same principle that makes 401k plans, when they work, effective for ordinary workers. The contribution comes out before the paycheck is spent. There is no moment of decision where fear or distraction can redirect the money. The system handles it. Automation does not make you a better investor by giving you better information or better timing. It makes you a better investor by reducing the number of moments when you can be a bad one. Consider two investors. Same amount of money, same market access, same fund. Investor A sets up a monthly automatic contribution and continues it regardless of market conditions. When markets drop significantly, the contributions still process. When the news is terrifying, the system runs as designed. Investor B invests manually. During good periods, they contribute regularly. When markets fall sharply, they pause. They wait for clarity. When confidence returns, usually after the market has already recovered a significant portion of the decline, they resume. Over a long period, the difference in their outcomes is not primarily driven by which investment they selected. It is driven by how many shares Investor A accumulated during periods when Investor B was sitting in cash, and by how consistently Investor A bought at lower prices during declines while Investor B was waiting for the fear to pass. The investment was not the variable. The behavior around the investment was the variable. Here are 3 things you can do. These are general educational observations, not personalized financial advice. Your situation depends on factors like existing debt, emergency savings, tax circumstances, and risk tolerance. 1. Automate a sustainable investment contribution. If you have access to an employer retirement plan with any matching contribution, that is usually the logical starting point. An unmatched employer contribution is money you are leaving on the table. If you are using an individual account, most brokerage platforms support recurring monthly contributions. The amount matters less than the consistency. Even a modest automated contribution, sustained over years, participates in the compounding that inconsistent larger contributions often miss. 2. Reduce how often you monitor the account. This is not about ignorance. It is about removing unnecessary decision points. Research consistently finds that investors who check their portfolios more frequently make more emotional trading decisions and tend to earn lower returns. Checking quarterly, or even annually for long-term accounts, is sufficient for most investors. Daily monitoring of a 30-year investment account is not information gathering. It is anxiety generation. 3. Write your rule for a market downturn before the downturn happens. When markets fall significantly, and they will fall significantly at some point during any long-term investor's experience, the emotional pressure to act is strong. Write down, before that happens, what you intend to do. For most long-term investors with diversified portfolios, the pre-committed answer will be something like, I will continue my contributions, I will not sell, and I will review my allocation on my regular schedule, not in response to news. A pre-committed rule is not infallible, but it places the decision-making with your rational present self rather than your reactive future self. That is not a minor distinction. Here is the final piece, the part the title actually promises. Why does almost no financial content focus on this? Not because of a hidden agenda. The explanation is simpler and more ordinary than that. Novelty creates content. The advice to automate a consistent contribution to a low-cost diversified fund and reduce how often you check it is complete in about 45 seconds. There is nothing to follow up with. No new strategy to discuss next week. No ongoing series of insights. No reason to keep subscribing, keep watching, or keep paying. Exciting strategies, active trading frameworks, and market commentary are different. They generate continuous new content because the landscape they describe is always changing. There is always a new development, a new analysis, a new opportunity. Each piece of content creates the need for the next one. The result is an environment where the advice with the strongest and most consistent evidence base, consistent, diversified, low-cost, automated investing over time, is systematically underrepresented, not because anyone is hiding it, but because it generates almost no content once it has been said. The content industry is optimized for engagement. Engagement requires novelty. Novelty and the evidence-based answer to long-term investing are in direct tension. Here's the central idea, one more time. Wealth is often not built by making better decisions. It is often built by reducing unnecessary ones and designing systems that remove the opportunity for emotional decisions to interrupt a sound, consistent strategy. The markets will rise, the markets will fall, there will be crashes that feel catastrophic and recoveries that feel too slow. The investors who tend to navigate this most successfully over long periods are not the ones with the best predictions. They are the ones with the most consistent behavior, often because they built systems that kept them consistent rather than relying on discipline alone. If this changes something about how you think about investing or financial content, subscribe to Wealth Tactics. Every week we take apart one more piece of money psychology that is quietly affecting your long-term outcomes. Drop a comment and tell me, is your current investment strategy automated, or are you still relying on manual contributions and willpower? I read everyone. This has been Eunice for Wealth Tactics. See you in the next episode.